Good day, and thank you for joining the Harmony Gold Forum Americas presentation. I hope you are all keeping safe. It is a pity that we are again unable to meet in person. Due to COVID-19 safety protocols, we will again be presenting this virtually. Take note of our safe harbor statement. If you are not familiar with our story, Harmony is an emerging market mining specialist with a copper-gold footprint. We have been operating for 71 years, and we are now the largest gold producer in South Africa by volume. We also have operations in Papua New Guinea through our Hidden Valley operation and our Tier 1 gold-copper project at Wafi-Golpu. Our investment case is exciting for many reasons. Through our acquisitions, we have re-engineered our portfolio and reduced the debt of our balance sheet and to create further opportunity. We have a clear dividend policy, which we aim to pay a dividend alongside our growth aspirations. And as a Rand gold producer who generates revenue in US dollars, we are geared towards a Rand gold price. Harmony is a 1.6 million ounce gold producer and are expanding our margins through organic growth and our new exciting projects. Our embedded ESG practices will create lasting legacies and ensure a sustainable future for all our stakeholders. I would like to spend some time today speaking about the projects we have identified. Harmony has an exciting pipeline of brownfield and greenfield opportunities. We are now in a strong position to take advantages of these opportunities to extract value and convert our resources to reserves both safely and profitably. We are inviting in exploration and have identified a number of opportunities, including Kelgold, our open pit operation in South Africa, the Tautona and Savuka shaft pillar extraction, and the Target North, a greenfields opportunity in the Free State. Wafi-Golpu is still in permitting phase, and we are committed to realizing our aspiration of being a specialized emerging market copper gold producer. The environmental permit for Wafi-Golpu has been approved, and we, together with our JV partner, continue to engage with the state of Papua New Guinea regarding the permitting. We have identified key projects that have the potential to not only extend the life of our mines and replace some of our mined out ounces. The key new projects include, first of all, Zaaiplaats, which is a deepening of the high-grade Moab Khotsong. Mineway Solutions is a low-grade surface treatment operations which we expand, and finally the extension of our Hidden Valley mine in Papua New Guinea that will extend life to 2027. Other projects already in execution include the Tshepong Sub-75 project, the Doornkop 207 and 212 levels and the related infrastructure upgrade, and the Target 1 capitalization and decline development. These capital projects are expected to add significant value to Harmony, and based on our assumptions, we expect an approximately 40% increase in net present value from these projects. Not only do we have expected improved grade, but we are also optimizing and extending the life of our mines too. Zaaiplaats is a high-grade, long-life ore body and forms part of the existing Moab Khotsong mine. It has significant resources of 3.5 million ounces below the infrastructure. More importantly, because of its high grade at 9 grams per ton, this will be a low-cost operation, and we estimate a life of mine all-in sustaining cost of approximately 512,000 Rand a kilogram or $1,090 per ounce. We will be seeking the triple decline system to the Zaaiplaats ore body. This project will be funded by the existing Moab Khotsong operations and will produce over 200,000 ounces per annum for 24 years, delivering a real IRR of 19%. Mineway Solutions, on the other side, was part of our recent acquisition of Mponeng and related assets. This is a high-volume, high-margin surface retreatment operation. Kareerand, which is the existing TSF, is reaching capacity, so this project will expand this facility. This low-cost operation will produce approximately 100,000 ounces per annum over 16 years with a life of mine of IRR of 43%. Harmony is currently a 1.5 to 1.6 million ounce producer. It is important that we invest in our business through these projects as they will further extend our production profile, expand our margins, and improve our profitability. We are investing in our future, and we have proven our ability to extract value from these types of projects and assets over our 71-year history. We will continue to create value for the investors while sustaining jobs, communities, and small businesses. It is also important that we continue to contribute to the fiscus of the emerging market countries we operate in. These projects make strategic and financial sense and will create a long-term value for all stakeholders and shareholders. In addition to have the new projects, there are other catalysts that will contribute towards the expansion of our margins. These include a number of our mines which are reaching the end of their life in the next few years. We will see the streaming agreement of Franco-Nevada coming to an end in FY25, and of our major CapEx projects will also reach completion. All of these will ensure a decreasing CapEx profile, driving margins higher. Our first strategic pillar is responsible stewardship. Safety is the foundation value at Harmony, and the safe production at all our operations at all times is non-negotiable. While we are making progress, accidents remain a constant and real threat. We are working tirelessly to ensure that we see results proportionate to the efforts we are putting in. I am, however, pleased to report that despite the loss of life incidents, the majority of our key safety metrics are trending in the right directions. Our lost time injury frequency rate in South Africa improved by 3% to 6.46 per million shifts from the 6.69 in FY20. COVID-19 remains a major focus and is considered a material risk to our business. Our vaccination rollout has been very successful. We are aiming to have 80% of our workforce vaccinated with the first jab by the end of October 2021. Just as we place emphasis on diversity amongst our workforce, it is essential to consider how we diversify our electricity mix. With hydropower already in use in Papua New Guinea, we have an exciting and a comprehensive renewable energy rollout plan in place in South Africa. The first phase includes plans for a 30 megawatt of renewable energy production, while phase 2 will see us develop and incorporate a further 73 megawatt of renewable energy into our plans. We have realized significant savings through our energy saving initiatives post the acquisitions of Mine Waste Solutions. We have also seen intensities all move down considerably due to the high volumes treated at our surface source business. We have clear copper gold aspirations, and we are committed to decarbonizing through various initiatives. The second of our strategic pillars is operational excellence, where we have once again shown in the past that we are able to extract the best from our assets. The acquisition of Moab Khotsong in 2018 and the then Mponeng and related asset last year has had a significant positive impact on our all-in sustaining costs due to the high grades at the underground mines and the low cost at high volumes at the surface source business. The mines in the red blocks, namely Target 1, Joel, Kalgold, and Tshepong, are all undergoing optimization projects to ensure margins expand and they contribute and produce to the plan, driving costs down. We have made significant progress at these operations during the course of 2021 and expect a vastly improved operations results going forward. Our all-in sustaining for FY21 was 723,000 rand and 45 rand per kilogram, marginally more than our cost guidance of FY21 of 700 to 720,000 rand a kilogram. Two contributing factors to the higher all-in sustaining cost was COVID-19 and the royalties, which each had around 2% to our all-in sustaining cost. Excluding these items, we would have been below the lower end of the guidance, and we are confident that we will manage to keep our costs controlled. We are expecting production to increase to approximately 1.6 million ounces in FY22 as a result of acquisitions and other mines regaining flexibility. We are also improving our grade. A constant trend in and expected grade guidance for FY22 will be about 5.57 grams per ton for our underground operations. We expect this trend to continue. Our third strategic pillar is effective capital allocation. I would like to spend some time here to discuss what our new projects in FY22. Harmony embarked on a growth strategy in 2016. I am pleased to say that we have transformed the operations significantly over the past 5 years. We've concluded the value accretive acquisitions, de-risked our portfolio, while also improving the quality of our assets. We have reduced our debt, placed ourselves in a strong position to extract further value through exploration and the development of various projects. And we will therefore be committing additional capital to these projects in FY22 as we invest in our future and growth. It's important to emphasize that we are investing in our high-grade, long-life assets, and 88% of free cash flow generated in FY22 was from these newly acquired assets and surface operations. The substantial shift from what we had in the past and perfectly illustrate our re-engineered portfolio, extracting more value from these assets, and is therefore essential. Our acquisition have added 28.4 million ounces to our resource, which has resulted in a 90% increase year on year. Similarly, our reserve have increased by 16% on the back of the new acquisitions, adding 9.3 million ounces year on year. The additional reserves will be from Zaaiplaats and Boneng Mine Waste Solutions and Hidden Valley Extension. Our capital guidance will see our sustaining capital normalized after a lower than usual FY21. We have a number of one-off this year and the next such of the additional businesses of our DSFs. We'll also see our sustaining capital reduced from FY24 as some of our older mines reach the end of their lives. As I mentioned, we are also spending on the new projects which will see growth capital increase this year. For example, the project capital for mine-based solutions is the highest in the first 3 years, as we ask to spend the Kalderan DSF immediately. From FY24, the number will be fall substantially. Our overall capital expenditure will decline, ensuring our margins expand as our investments in our high-grade and surface assets start paying off. Our fourth strategic pillar is cash certainty. FY21 really was a fantastic year, and we delivered an exceptional financial performance. Headline earnings per share increased by 700% to 60 US cents from a loss in FY20 of 10 US cents. Our EBITDA increased 64% to $636 million from the $383 million in FY20. The 26% increase in our production combined with a 16% higher US dollar ounce gold price resulted in a net profit of $352 million in FY21. We have a clear hedging policy where we only hedge if we are able to lock in a margin of 25% above cost, and our existing hedge book is favorably positioned relative to the current gold price. Our balance sheet has continued to strengthen, and we have managed to deliver a considerable over the last 3 years. We also managed to reduce our debt payment by a further $41 million during the course of the financial year, and currently have a net debt to EBITDA ratio of 0.1 times. In addition to reducing our debt, we also have created balance sheet flexibility and have $500 million in headroom available through cash and undrawn credit facilities. This gives us substantial room to maneuver, but also provides a strong buffer during times of uncertainty. This will allow us to take advantage of the kind of opportunities we have discussed, but also by others which may yet present themselves. In conclusion, I'd like to leave you with this key takeaway from Harmony. Harmony is positioned for success in FY22 and beyond. We have solid building blocks and great projects in place to ensure that we deliver against our strategy of mining safe, profitable ounces while increasing our margins. We have optimized our existing operations and have integrated ESG practices throughout Harmony. Our acquisitions combined with our responsible hedging strategy will ensure that our balance sheet remains strong and flexible so that we can deliver positive returns to our shareholders and stakeholders for many, many years to come. I thank you very much for listening to me.